it is worth reminding ourselves, I suppose, that yet again there are anti-forestalling rules. In the same way as with pension contributions, they don't trust us not to go out and fill our boots. Ditto VAT. They suspect that people will rush out and undertake transactions which really belong in the post 4th of January 2011 era, where they should be taxed at 20%, and drag them into the earlier era to save the VAT. And obviously that's going to be tempting to businesses that can do it. But there are anti-forestalling rules, and what's the effect of that? It is not simply to put you back where you would otherwise have been. It is to put you back where you would otherwise have been and impose a surcharge on top. So they are adopting a fairly aggressive approach to this. So anyway, that's VAT. That's where we are at the moment on VAT. Corporation tax. The Chancellor, in his emergency budget, he made various statements, of course. He was up speaking for an hour and 15 minutes, whatever it was. But he said two things which struck a real chord with me, a real chord. One of them was that we have not got where we are today. We are not in the mess that we find ourselves in now because we have been undertaxed. It is because we have overspent. And that struck a chord with me. I think, you're damn right we've been. I mean, when you look back over the Blair-Brown era, if you like, I don't want to be political about it, but just look over that. And when you remember the so-called stealth taxes that were imposed, starting in the first Brown budget of 97, what did he do? He abolished the recoverable tax credit on dividends for pension funds. That did not do pension funds any favours, I hasten to observe. He then removed the refundable tax credit for little old ladies, let's call them. Before then, you could get a refund of the tax credit on a dividend. After 99, nobody could. After 97, pension funds couldn't. But then what happened? They did away with various reliefs, didn't they? Married couples allowance, all those things. Miris relief, all, it just went. So anyway, haven't got where we are today by being under tax, that's for sure. But the other thing he said, which is really where I'm coming from, he said that he wanted the corporation tax rate in the UK to be the most competitive out of all the G20 economies. He said that what people do is they compare rates of tax. They compare headline rates of tax in deciding on very, very important decisions about where you might cite your holding company or where you might have a trading subsidiary. They are based on things like, what's the rate of tax? I go to international conferences and people say to me, what's the rate of tax in the UK on capital gains tax? And I'll say, oh, well, it depends, but its headline rate now is 18% or 28%, whatever. And they say, oh, that's not too bad. Our headline rate of tax is 35% or 40%. And I said, well, yes, that's fine, isn't it? That's fine. But you've got reliefs, haven't you? I was talking to a Maltese gentleman. I said, look, you've got reliefs. If you own an asset for, let's say, 10 years, Mr. Maltese gentleman, how much capital gains tax will you pay in that circumstance? Oh, none. So, well, it doesn't matter, does it, what your headline rate is? It matters what the rate is compared to the reliefs that meld with that rate. And corporation tax is a classic. People ask me all the time, what's the corporation tax rate? Oh, ours is this, ours is that. Is it low, is it high? In America, corporation tax might be levied at 31%, 35%, depending on what state, but you can amortise freehold property costs against your tax bill in America. You can't do that in the UK, so the headline rate of tax is meaningless, really. But Osborne knows it, but he knows that if you get it down, people will latch onto it. And that's what he's doing. So, corporation tax coming down. This is a good thing. So, corporation tax, with effect from the 1st of April 2011, the small company rate coming down from 21 to 20. Nice and low, that's good. The large company rate coming down from 28 to 27, and then next year, or the year after, 26, 25, ... to 24. Very good. So, I approve. Now that gives rise to some interesting planning points. And at the end of this session, I am going to give you 10 planning points to think about and take away. And an opportunity arises, does it not, if you have got rates of tax like corporation tax that are coming down. Because what's income tax doing? Well, it isn't doing anything under the coalition government. The doing was all done by the previous lot. But where are we now? We have got, as I said earlier, a 50% rate of tax. Is the top rate of tax really 50%? I've just said it is. So do you believe me? Ladies and gentlemen of the audience, is it really 60%? Well, the answer is, well, depends how you look at it. I have told you already that if your income is between £100,000 and £113,000 roughly, you lose the benefit of your personal allowance on a £1 for every 2 basis. What does that do to your effective tax rate? Well, what it does to your effective tax rate is it increases it by 50%. That's what it does in that band. At that level of earnings, you would be paying tax at 40% normally, but if you get relieved of £1 of your allowance for every £2 of income, that means that the effective tax rate on that income is 60%. So there's a thought, 60%. But even that, is it right? Because how do dividends work? Who knows how dividends work? It's all very complicated now, isn't it? It used to be easy. If you go back before 99, dividends were relatively straightforward, relatively intuitive. You would get a voucher if you got a dividend from ICI, whether it's ICI or your own personal company, doesn't really matter, but you would get a voucher, and in those days the dividend might be £80, and the voucher would say there is a tax credit because we have accounted for something called advanced corporation tax. Sort of words it would use. It would imply there was a link between the advanced corporation tax and the tax credit. It wasn't really, but that linkage was sort of implicit from the voucher. Don't worry about it. But the advanced corporation tax was 20%. So an £80 dividend, the revenue would say, oh, that's 100 really, with a 20 credit. If you're a basic rate taxpayer, we don't want any more tax. But if you're a 40% taxpayer, we want another 20. Yeah, another 20 out the 80. Which is 25% of the net. Yes, everybody understand that? Now, what happened when in 99, Blair and Brown between them thought it would be a right old wheeze to pretend that people around here pay tax at 10%. What we'll do to add to this pretense is make the tax credit on dividends 10%, which is what we've got at the moment, yes? So now, if you get a dividend, whether it's from ICI or what, let's make the number 90 to make the maths easy. The revenue will say, oh, you've got 90 plus 10 is 100. We want higher rate tax on that. And at what rate? Well, the rate is 32.5%. If they'd left it at 40, the amount of tax on the dividend would have rocketed. So they had to bring the rate of tax down because the tax credit went down. Yes, everybody follow that? Everybody follow that? So you have tax on dividends at the 32.5% rate to make the net tax on the net dividend 25%, like it always was. I always thought they're bound to change that 32.5% rate. They won't be able to resist it. We'll wake up one day and suddenly, oh, it's 40%. We can't remember why we had it 32.5, and it's now 40%. But they didn't do it. They haven't done it. But when they increased the real top rate from 40 to 50, they increased this dividend rate from 32.5 to 42.5. Now, how does that, when you crunch the mathematics, and I won't do it here without the benefit of a flip chart, but when you crunch the mathematics, that makes the effective rate of tax on a dividend 36.11% on the dividend that you actually receive. The 90 that you receive, when the revenue grossed up to 100 with the tax credit, then tax it at 42.5 and give you the tax credit, what you then pay is 32.5 out of 90, which is 36.11%. Yes? Now, it's complicated. It's very complicated.